Okay, welcome back, founders. We are here for the final segment of Better Understanding Debt Financing. And Shannon is back with us for part 3. She's given us so many important things to think about in parts 1 and 2. And Shannon, actually, I have been told, okay, I'm just, sorry, I'm going to step back here for a second. Shannon Pestun is the founder and CEO of Pestun Consulting. And she's also the co-founder of the Finance Cafe, right? An online financial literacy forum for women entrepreneurs. So sorry, Shannon, I just needed to do that because I have been told I need to be consistent at the beginning of every episode so everybody knows who we're speaking to and the power that you're bringing to this conversation. So we're going to pick up where we left off, talking a little bit about ratios. And I'm amazed at how many founders out there are, and because I was one for the longest time, really don't have a sense of ratios and what lenders are looking at when they're crunching the numbers and they're saying your ratios don't look great. So I know you've talked a little bit about that, with respect to the debt servicing ratio and the liquidity, but maybe if you could just map that out for us in the simplest of terms so we can wrap our head around it and be better prepared for what the lenders are going to look at.
First of all, I really want to thank you for being vulnerable in this and saying that this is something that you had to learn as well, because many entrepreneurs do. Again, it goes back to, we didn't start our businesses because we were strong accountants. But when you start getting into the numbers and into the ratios, this is where things actually get really exciting in your business. And I'll be the first to say too, I almost failed every accounting class that I ever went into. When I became a business lender, full disclosure, I didn't know how to read a financial statement. And I was intimidated by it, because the numbers didn't have any meaning to me. And I didn't see how the numbers connected. I didn't understand how the income statement and the balance sheet were actually telling a really relationship-driven story of what was happening in the company. And this is what ratios allow us to do. So when we're going into the bank, and you're right, a lot of entrepreneurs can't speak to their ratios. I actually never saw a business plan that came in when somebody was looking for money that said, here's what my ratios look like. Because ratio, and I keep thinking to myself, like, why don't we put that in business planning? Yeah. Because imagine if you go to the bank, because your ratio is going to tell you certain things like, how profitable are you? How efficiently are you running your company? How leveraged are you? I mean, there are some really important, ratios that are telling the story of to a lender. So when you're going in, I mean, let's talk about some of these ratios. The first ratio, and again, it depends on what type of loan you're going for. Banks aren't going to be all looking at the same ratios at any point in time. But primarily the 3 big ratios are looking at your liquidity ratio. You talked earlier about working capital. And working capital is really important, particularly because the banks want to see how solvent you are in the short term. Can you pay your debts? So what they look at is they'll take a look at your current assets. So anything that you own, assets are what you own, anything in the first that's owned within this year, and you divide that by your current liabilities. So anything that's coming due in this coming year. So there's a time frame that matches here. And so that ratio, banks want to see it at about a 1.25 to 1, which means when you divide the assets by the liabilities, what you're showing is that you have, first of all, more assets than you have liabilities, but you have about $1.25 to cover every dollar of debt that you have. So you've got $1.25 in assets to $1. So that's the working capital ratio. And it's hard to kind of see this without being able to draw it out. So, but really what that's looking at is how liquid are you? How solvent are you in the short term? That becomes really important when you're looking at things like lines of credit, because sometimes as a company, you're going to need more working capital. And the banks are going to be looking at, okay, well, why? And how would this help you? And for a lot of entrepreneurs, particularly those that extend credit to their customers, that working capital is really important. If you're cash in, cash out, it's a lot easier to manage the cash of the business. Yeah. But this all comes down to cash management. And a lot of entrepreneurs aren't watching their cash closely enough. So this is where the working capital becomes really important.
Brilliant, brilliant. I suspect, especially because you're in Calgary, Alberta, resource businesses, right? Resource service businesses that, that notorious 90, 120 day turnaround before you get cash in. Anyways, okay. So I was diverting from our conversation, but I love that 125 too, like actually nailing the ratio. Brilliant. Thank you.
Yeah, you're welcome. And so the next ratio that becomes really important is how leveraged you are. So banks and investors, and it's both. It's not just debt financing, but people want to see, how is your company funded? Have you got skin in the game? Do you have too much debt? Because if you have too much debt, that's also a worrying factor for companies as well. And so typically the banks, I mean, the ratio changes, and maybe in this, like, we're dealing in COVID times right now, but generally speaking, it was sort of this 75% mark. So 3-to-1 would be the ratio. So banks would give the 75, you've got 25% in. So, and they're going to be looking at what your total debt looks like against your total owner's equity. So they're going to be looking to see how much debt you have against those liabilities. So that's an important ratio.
That's higher than I thought it would be, quite honestly.
Well, and I think I'm being generous in this one because, again,
Okay.
during pandemic time,
Okay.
and in different industries as well, it's kind of hard. Again, this is where business lending gets a little bit complicated because different industries have different ratios as well. So some of these benchmarks will come into play. The banks will take a look at what should the debt to service or debt to equity look like for certain companies. So it's not, again, not a broad brush stroke approach, but it would, so typically I'd say like 3-to-1 would be still within the reasonable category.
Okay.
And the last ratio that banks are really concerned about has to deal with cash flow. So we talked earlier, how much available cash do you have to cover your loan payments? And so they'll take a look at what your net income is. They're going to take a look at what your loan payments are. So basically it's the free cash that you have in your company, the free money available in the company to cover your loan. And they want to see about a 125, again, $1.25 to 1. So that means, again, for every dollar that you owe, you've got 125 to cover that loan payment.
Brilliant. And so when I think how we started this off too, and we were talking about ratios, knowing your ratios, going in, calculating your ratios, understanding your math, understanding why you might not be where you need to be, and not waiting for perfection, but being able to explain that situation. So when we look at the tools or the materials needed, like how really to better prepare yourself for that first meeting with a lender, we understand, look at your ratios. What other tools should they have available? What other materials is a lender really wanting to look at in that first or second meeting? What does that look like for you?
So the first thing really is the business plan. Like the lender wants to see what's happening in this business. What's the opportunity in front of you? Like they want to understand the management. They want to understand the financial side of the house. They want to see what's unique about you, how you're deriving your revenues, and what you're expecting to do in the future through lending or borrowing money to grow the company. So the business plan is vitally important. Inside that business plan, you're going to have the financial section, which would have, your balance sheet, your income statement, your statement of cash flows. But typically, depending again on how much you're borrowing, the banks are going to ask to see the past performance of the company. So be prepared to bring in 2 years of notice to reader statements that the bank can sort of assess, because they're going to do their own ratio calculations. They're going to take a look at the financial strength and health of your company. So they're going to be assessing that. Another reason why you want to be able to know your ratios going into the bank is you can talk, when you're talking the bankers talk, it suddenly gets you, again, it goes back to, it's sort of your superpower as an entrepreneur. There's going to be some personal documentation too, like your personal financial statement will be asked for. You'll be asked to approve a personal credit search. And depending on, again, what the loan is for, you might be asked to take a look at the aging accounts receivable and accounts payable statements. You can expect as well projections and cash flow projections. So a lot of it depends. But one thing I would say, though, that entrepreneurs often don't know is when they're going into the bank is what exactly they need. And so if the loan is to buy equipment, that you want to talk about that equipment and how it's going to help move the business forward. So it's telling that story of, again, why this loan is going to help me. So knowing your loan purpose is really important, and knowing what you're going to be putting in, again, to match that debt to equity, knowing what you're going to be giving up. So those 5 C's of credit, if we can go back and start saying, here are my mitigating factors, you're talking the banker's talk, and it's so much more empowering to have that conversation.
Brilliant. Brilliant. And you bring up a really good point. I remember with my lending hat on, one of the questions that the founder was not always necessarily in a position to answer: how much money do you need and what are you going to use it for? And understanding either startup capital or expansion capital, understanding assets, and then understanding working capital, right?
Yes.
And that lenders lend for different reasons, as you mentioned, and being able to kind of divide it into those three categories to just be able to go boom, 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 this is what I need. And just really quickly, you've already been so generous with your time. I'm curious though, contingency funds. So let's just say a founder has this beautiful, 2-year cash flow projection and everything's, adding up and it looks good. Will a lender lend for contingency purposes, or does that typically get put into an operating line so that there's a buffer in the event that the plan doesn't go according to plan? Sort of throw that on you last minute. I just came to mind as we're wrapping up here.
Well, having a contingency plan is all about working capital, right? So as an entrepreneur, you want to have that working capital. So the banks, I'm not sure I'm answering your question properly, but every entrepreneur should know, if my business, if I lost a major customer, if I wasn't generating revenues for 6 months, how much do I need to have? I mean, the banks certainly look at that, but that's where your business plan comes in as well. And again, this whole 5 C's of credit, the banks are going to say, well, what's happening in the industry? What could derail this loan? What could make this good loan on paper go sideways? And so every entrepreneur is at risk, but keeping a healthy working capital, keeping cash in the company is vitally important. I understand you don't want to always keep cash in a bank account because it's not necessarily working for you, but knowing how to invest that money and working with an advisor inside the business too, to help you manage your cash as efficiently and as profitably as possible.
So smart, so smart. I will just say we did an episode with Neil Jones from BDO where he was talking all about stress testing your financials. And so if anybody's interested in doing that here, it's just like you talked about, Shannon. It's about, what happens if this portion of the revenue stops? What happens if you lose an employee? What happens if that supplier goes by the wayside and now you're paying, 7% more on those costs, just to see what that does to your bottom line, to make sure that you've got
yeah. And, great point. And like the stress testing is I'm going to put it in simple terms too, because sometimes people think that it's this big elaborate thing that you need to do, but sort of that worst case, best case, and realistic case. And it's just manipulating some of the numbers. So working with an accountant who can put this in an Excel spreadsheet for you so that you have a formula that you're working with. So if I increase my revenues by X, how is that going to shape, things at the end of the year? Like as an entrepreneur, again, once we know how the numbers work and once we understand the story, the power that you have as a knowledge base to run your business is just so much more. But the stress test is super important, but really just a budget looking at your best, worst, and realistic case scenario. And I encourage everyone to do that.
I love it. Oh, Shannon, I could talk all day with you, I think. Yes. Anyways, we won't do that to you. We won't do that to the founders. We can only take so much information on numbers, especially money and finance at a time. But thank you so much. You've been so generous with your time this morning. So much value in this conversation. So many tips. If you're watching this, please look at the show notes. We're going to make sure that a lot of these tips are just kind of punched out there very powerfully in the show notes so that it's a good recap for you. Also, please be sure to download the tip sheet because this is where we're going to have a lot of Shannon's information in there that's actually in written format. And please, before you go, don't forget to download some of the tools. So Shannon, some of the tools that we're going to put in addition to this episode, we've got a cash flow forecast. We've got a startup cost template. We're going to throw in there a personal budget so that owners can understand what they actually need to be generating from this business. And I think we're going to have some links to understanding your credit as well. But it is actually really easy these days, isn't it? When with your bank to typically, I know a lot of banks right now just say, here, look at your credit score, and they make it super easy without you having to go through a lot of hoops. So, okay, let's leave it there, Shannon. Thank you so much.
Thank you. No, I hope this was helpful to the founders and, wishing everyone continued success on your entrepreneurial journey. And Tanya, thanks for inviting me to be a part of yours and the founders' journeys today.
Oh, well, thank you. Hopefully we can have you back into the lab sometime soon. And again, just a huge shout out to our episode champions, Community Future Sunrise. Thank you for all that you do for founders. Lenders really were, they were the front frontline responders for entrepreneurs across the country through this pandemic. So thank you for the work that you do. Thank you, founders, for watching, and we will see you in here for the next episode of the Gab Lab. Bye for now.